It's an all-American USA episode.
USA. USA.
USA! Let's go digging for value. I'm Allison Southwick, and as always, I'm joined by Taylor Muckerman and Joel South, my gold medal and analyst here.
Yeah, you're too kind.
Yeah.
You're too kind. We're the only competition, so I guess that.
Well, you still get maybe one of you is gold and the other one's silver.
You hear that? Where the money is?
Yeah, we're coming after you.
Bronze.
All right, we've got a few headlines to cover today. Yep. We're going to dig into LNG and CNG a little bit and some earnings. You're gonna tell me. And we're gonna talk earnings, a preview and a review. Sound good?
Makes sense.
Good.
First article we're gonna get to is over at National Journal, where they are counting down the 5 biggest energy changes in the past 6 years. All right, I'm gonna try and count them down really quickly for us.
Count them down.
All right, America's oil and natural gas boom, the rise of the EPA and the fall of climate-friendly Republicans, environmental movement flipping from top down to bottom up, imports and exports of fossil fuels, and renewable energy growth, which is objectively significant but still relatively small.
Which year didn't have a big event? It's only 5 out of the last 6 years.
I guess there's like
Or
a
just,
sweeping
just,
trend.
Just the 5 thing over the past 6 years.
Yeah.
Okay.
So, of these 5, which one do you think is the most significant?
Well, it's got to be the oil and gas boom. I mean, that's clearly number one. But I think 2 actually are pretty significant here. And I think the oil and gas boom over the 6 years, if you go back 6 years ago from almost right now, you're seeing the very first well being drilled in the Eagle Ford. Now you're getting up to close to 1 million barrels of oil equivalent out of that field. It just shows you how much we've come in the past 6 years, and then just what natural gas has done just to revolutionize manufacturing and really help get us over the hump of the fall of 2009 and all the problems we had there. The other thing that I think is very important is taking the energy upside down and seeing what we're doing with that exporting natural gas. Even on Tuesday, we got our 5th LNG export facility passed by the Department of Energy to ship to non-free trade agreement countries. So I think that's very important, just showing how much we've come. We're spending billions of dollars 6 years ago to import natural gas. Now we have our 5th project that is passed to move on.
It's interesting to see the Sempra Energy was the company that got approved, and it really didn't even move the needle for the company today, just because people have already kind of baked in the idea of the next few companies in line getting approved for LNG exports.
And there's more to come too.
Yeah.
What, like who?
The next ones are going to be out of Oregon. The next ones on the list to be approved for
First on the
non-free
West
trade.
Coast, yeah.
Yep.
Oh, all right. Well, that was the trends of the last 6 years. I want you to make a wild prediction for the future 6 years.
Wow.
I think the wild prediction for the next 6 years is everybody knows that natural gas is going to be one of the big fuels that we're going to use, but I think renewables is really about to really take off again. And I think not only solar, what we're seeing a lot of growth in, but I think wind. Right now, about 15 million homes are powered from wind. And I think that is going to grow significantly. So I think together with renewables in general, we'll go from about 4.6% of total generation and almost double that. I think we'll be close to 7 to 8% in the next 6 years, which would be tremendous.
Now, I actually am not familiar with any companies that are in wind. Are there any to watch, or?
Well, I think you'd have to look at the infrastructure companies, the people that are actually building the turbines. GE, for one, is huge. Siemens. Those are the companies that I think have a lot of, will benefit a lot as that grows.
And they've been able to drive the cost down immensely, so it's profitable now for sure.
All right, well, let's move on. We're going to head over to Fuel Fix, where, Taylor, we are learning that instead of being just a successful refiner, Phillips 66 is taking these profits and focusing on new projects, including energy transportation, storage, and processing infrastructure. So what do we know so far about where this $3 billion is going? I've outlined it generally, but what more do we know?
Well, it's going down towards the Gulf of Mexico for fractionation, also to kind of export butane and propane natural gas liquids products starting in 2016, up to 4.4 million barrels per month trying to export. And it's a huge shift for this company because they're the huge refiner. That's the name of the game for them. Even after they spun off ConocoPhillips, or they were spun off from ConocoPhillips, they're the 2nd largest energy company in the United States, still by sales. So to see them completely about face and only spend capital expenditures on the refining side for maintenance is a big deal. And I think that may be one of the reasons why they're kind of okay with exporting oil from the United States, because now they're going to be in the deal of shipping LNG or NGLs and also processing those to then give those to chemical companies like Dow and DuPont so that they can turn those into plastics and all myriad forms of downstream uses.
So who's their competition in this space that they're entering, and should that competition be worried?
Oh, well, the competition's already got a nice little leg up. You look at Enterprise Product Partners and you look at Kinder Morgan, two huge companies in the transportation space, already looking at fractionating up to 400,000 barrels a day, which is 4 times the amount that Phillips 66 is talking about. While it's not online yet, it's in the works. So there's some pretty heady competition here, but the way that you've seen natural gas liquids being produced lately, I think that added capacity is going to be needed, and they could easily fill that 100,000 barrels a day. So it's a nice move, and with the volatility of refining that we've seen a lot lately and the tightening spreads internationally, I think it's a very wise move for Phillips 66.
It's interesting if you look at how much they're actually growing in that space. They're expected to get the same amount of revenue from their refining business as that chemical business in the next 2 years, 2.5 years. So they're really transforming their business, and I think it's a great move.
Yep, I agree.
Great way to go.
All right. Now let's stay on Fuel Fix because we are going to also head to Capitol Hill. Speaking in front of a group of conservatives, Ted Cruz told the room to stop obsessing over the Keystone XL, urging them to think beyond the pipeline. Apparently, he's dropped Obamacare and has picked up the issue of energy and has a bill coming down the pike. Joel, so does this mean that energy is going to be on the forefront now, or Obamacare is not
Obamacare is going to be there, especially when there's so many issues of people trying to get signed up. However, this is a first-term senator from Texas, and Texas is still a huge, huge energy state. So obviously, he's more focused on that. And a lot of the refiners do want Keystone XL to bring some of that oil down, but he wants more drilling in his own state. The Permian Basin is one of the prolific plays right now. The Eagle Ford is huge, so he's looking at opening up more federal lands to get more revenues in his state.
And is that what we're going to see in this bill, or?
Yeah. Basically, the bill talks. I mean, part of the bill is wanting an immediate approval of the Keystone XL, but he also gets into opening up more federal lands, also getting more offshore drilling. He wants the Gulf of Mexico to really be more leases in that area. So, I think that's kind of where a lot of his focus is, but I don't technically see that as a lot of the issues. There's a lot, if you look at the amount of drilling that's going on in the Gulf of Mexico right now, it's past the Macondo stages. There's a lot of leases in that area. So I think a big thing that he should be focusing on, that the United States will want to look at, is the Keystone XL and getting that relationship with Canada back online, especially as more people start moving up to the Arctic to drill. That's kind of a contentious area where you have ownership of Canada and Alaska. So I think getting the Keystone XL will get us on better terms with our northern neighbor.
Yeah, you don't really want to sour that relationship, especially because you've seen them be friendly in terms of allowing Chinese companies to come in and buy up some assets. So if that continues, we could really be in trouble.
Yeah, so maybe let them win a few medals in the Olympics.
Yeah, why not?
Give them a couple bronze.
Yeah, a couple bronzes will work. We've already won a few, so it's running out of time. But I think we can let it happen.
Well,
maybe on the skeleton or something like that.
Let them have a couple.
Yeah, or curling. They're very good at curling.
Are they?
Mm-hmm.
Apparently that's one area that China might expect a gold. I don't know. I just read a headline. I haven't watched any of the Olympics. So.
You should watch curling. It's awesome.
I know. 70,000 people in curling.
I'm a big shuffleboard fan, so
curling's
it's like
amazing.
the natural extension in the Winter Olympics.
I feel like all I do for every show I host is talk about curling, but whatever.
Is that right?
It's awesome. It's amazing. All right, let's move on.
Okay, fine.
Okay, we're heading over to Reuters. A group of investors are not so happy with Continental CEO Harold Hamm. I'm probably going to oversimplify it here, but they are accusing him of using Continental as a piggy bank to fund a pipeline being built by his other company, Highland Partners. So as the article points out, conflicts of interest are a growing concern for investors, particularly for investors who are in energy companies with influential CEOs. Where else have we seen these accusations of conflicts of interest?
Well, we've seen it with the same class of oil driller that Harold Hamm is, and that's the wildcatters. Not to be confused with our in-house wild card, but these are the guys that went out and first started shale drilling. Harold Hamm pioneered the Bakken play up in North Dakota. He's actually owns more oil than any single human being in the United States, around $13 billion worth of it, because he owns, I think, 68% of this company. But you've seen other CEOs get ousted. So while I don't see that in his future, you've seen Aubrey McClendon and Tom Ward at Chesapeake and San Ridge, respectively. Both try to pad their own pockets with a little bit of company misdealings. Aubrey McClendon, for example, bought into a lot of the wells that Chesapeake was producing. Said he would fund the debt of his proportion, but obviously investors weren't too keen on that. he got the boot, and Tom Ward as well was questionable, and his son was buying assets next to Sandridge's real estate. So investors came in, activist investors came in and got him removed too. While I don't see that the future of Harold Hamm, because he does have such a large ownership stake, it's obviously kind of permeating in this whole class of energy company founders started back in the 80s and 90s.
Yeah, let's talk a bit more about what's going on with Continental and Hamm here. What do we know so far about the accusations and maybe how this will play out?
Well, apparently he's got a side business on oil transportation through pipelines, and it's a $300 million project which Continental invested in. And this is a company that's been outspoken about their use of rail, so investors are kind of wondering why they're investing in a pipeline business. It is 100,000 barrels a day from North Dakota to I think, Wyoming. So if they could get some of their oil on there, it makes a little bit of sense because they're desperately in need of takeaway capacity in the Bakken. But this isn't the first time he's come under fire. He's been in the web of share repurchases through another company of his. And then I think there was another transportation deal through a pipeline back in 2010 that investors gotten a little bit of an uproar about. So I didn't realize all the historical things about this, but seeing this, sheds a whole new light onto some investor controversy at Continental Resources, a company that's returned a lot of money to shareholders over the past 5 to 6 years.
All right, well, that's going to do it for the headlines. Now we're going to do a deeper dive into a couple issues right now in energy. The first one is shorting. We're going to get shorty here because short selling for many solar stocks, including SolarCity and SunPower, is really on the rise. Now, we here at the Motley Fool are long-term buy and hold, bottoms-up investors. So why should I care about short selling?
So I think you should care if you see the float up plus 30% like you're seeing in a lot of solar companies. Basically, if you're selling this company short, you're obviously hoping the company's share price depreciates. However, if these companies keep hitting the record growth that you're seeing over the last year or so, these companies, the people that shorted the stock have to go out and buy that, which will slowly put a lot of pressure, upward pressure on the stock price. So if you truly believe in solar and you think that there's a big future there, one of these quarterly reports might just spark that, and you could see a lot of share price appreciation. So, it could be very scary to be a short seller because the best you can do is 50 or 100% on your money. Yep. Where if you buy it long and you really believe in it, I think you can see price appreciation that really soars. And if you look at SolarCity over the past year, it's up 375% or so.
Astronomical.
So in another one, SunPower also has about 36% short interest. And this is a company that is about 50-60% owned by Total, and they're in a lot of different areas throughout the world. A lot of growth in the utility side and the residential leasing side of their business. So, if they have a great quarter, they announced earnings on Wednesday after the market. If they have a strong quarter, you could see that go forward. You could see Total maybe jump in and buy the rest of the company. So as a short seller, I think that's a pretty dangerous position to be in. And as somebody that owns personally SunPower, I think that's a great position to be in for the long term.
Yeah, and then talking about SolarCity, how they're up so much, they've been hitting on all their numbers, which Joel actually alerted me to the fact that SolarCity was about 37% short interest, and it caught me off guard because they really haven't had a misstep over the last 6 months to a year. They've started allowing individual investors to buy into their bond-like securitizations of their residential leases, whereas before it was just institutional investors. So they're getting cheaper financing now, and they're in 14 states, and now home builders are signing up with them to actually bake these solar panels right into the construction of the home, so it's a much more seamless process. And they're trying to double installations this year over last year, which was already a huge year. So if they kick it out of the park, watch out for these short sellers.
They're going to kick it out of the park.
At the end of last year, they already had huge growth figures, and they went and their guidance they kicked forward. So they were even doing better than what they were originally planning, and they're looking for 70% compound annual growth rate through 2018, where they were looking at that 1 million installation. So I think it's a
watch out.
Kick it out of the park.
The park. Maybe hit a touchdown. We'll see. All right, now the next deep dive we want to do.
We're talking finance here, not sports, all right?
All right. I don't know. I enjoy calling someone out when they mix their sports.
No, fine. Yeah, I know.
You can kick it out of the park.
You can, I think. I've never seen it, but
You can't you can't kick it out of a
They're
park.
playing in a short park and you're playing kickball. You can
Yeah, I guess in Little League I've seen it get kicked.
All right, we're going to move on to our next deep
Too
dive.
many rabbits being chased here today.
So in our next deep dive, we're going to take a look at, in a segment that Taylor wants to call.
Feeling gassy. America has eaten too many Brussels sprouts lately, and it's just got too much gas, and now the transportation
All right.
sector wants a piece.
So why are we feeling gassy? Because big companies like UPS and AT&T have been shifting from diesel to a natural gas fleet of trucks. But now the little guys are making the switch and taking advantage of the cost cutting. As one spokesperson in a Fuel Fix article, he works for a baking company, said he described it as a no-brainer when natural gas is $2 cheaper a gallon than diesel. So when we're talking about natural gas here, we're talking about CNG, compressed natural gas, and LNG, liquid natural gas. Can you talk a little bit to me about the difference here in the fleets and the usage of the two?
Yeah, I mean, you use CNG if you have a fleet that's usually within a city. So if you look at the refuse business, they're basically under 200 miles a day. The tanks on CNGs are a lot heavier, so you need that big truck. For long distance people, they want LNG because it packs more fuel in there, and you can also get more horsepower. So if you're trucking a lot of loads over, throughout the country, you really want the LNG. And right now you saw a lot of big companies jump in and have that city fleet sort of. And now you're seeing the little guys jump in because people like Clean Energy Fuels are now building out a lot more of the long-term or the LNG facilities for the bigger trucks.
So what kind of companies are we talking about when we're talking about this trend here?
Well,
what should I be watching?
Yeah, I mean, GE's poured a lot of money into clean energy fuels. So you're looking at this company, their GE Capital has lent out a lot of money, and GE Oil and Gas has gotten into the mix as well. So they're a heavy investor, and to see a company like that that's been progressively picking up more and more energy assets to back a company like this, I think speaks volumes a lot more than some of the recent short investors, speaking of short investors, came out and really kind of said that clean energy fuels might be on the wrong side of this LNG, CNG debate. But they're exposed to both sides. So what you're seeing with all these smaller companies, a lot of them down in Texas, because Texas is obviously ripe with natural gas, so it's a perfect testing ground for these smaller facilities to get in. But you're looking at 664 natural gas refueling stations right now, according to the Department of Energy. So that's been a lot of headway. Some of those are private, but a lot of them can be publicly accessed. And what Joel was mentioning with the CNG, a lot of the bigger firms are building their own fueling stations because they return to the same base every night. So that's what you're seeing with that CNG. UPS is the largest private fleet for that purpose in the country, and they've got FedEx hot on their tails because they don't want to lose out on the margin game. And the leading providers of the long haul engines is a JV between Westport and Cummins, and they're just now getting their 8 liters off the manufacturing floor. So you're going to see maybe 10,000 of those come off the line this year, and that's what Clean Energy Fuels is expecting. And with the big sell-off to start the year, investors should really take note of this.
Yeah, and even the short people are saying that they don't have that exposure to LNG. Right now they have 317 CNG stations. They have 157 LNG stations. And if you look at how many trucks that have been ordered so far this year, there's about 3,500 of them. About almost 60% have been LNG. So I think Clean Energy Fuels is winning on that side. So as a short seller, I'm not betting on that.
So it's smarter to invest in the natural gas as opposed to the engines and that kind of thing, or?
That's what we've seen so far, I think.
Westport
Yeah. There's a lot of there was a lot of uncertainty with these companies. Westport's been something that the Fools talked about for a long time, but it's just now starting to get picked up because they teamed up with Cummins, and their engines are finally starting to roll off the assembly line.
All right, well, that's going to do it for our deep dives. Now it's time to take a look at earnings.
Okay.
As I promised, a review and a preview. So for our review, Pioneer Natural Resources, ticker PXD, just released their earnings report for Q4 2013. Joel, what did we learn?
Back up the earnings truck.
So what we learned, they didn't have a bad quarter. I mean, they were pretty much on what a lot of their guidance was. Cash flow got hit a little bit. The expenses ran a little high. But, this company is still one of the best that's in the space. They sold off about 3.5% today because of that cash flow issue. But if you look at what they did this last quarter or so, They've added over 140 million barrels of proven reserves. They're in one of the best plays right now in the Strawberry Wolf Camp. That if you look at the potential resources there, you're looking at close to 9 billion barrels of oil equivalent. So this company is in a fantastic place. They're increasing their capital expenditures to really go after that. They have the balance sheet to do that. So of the $3 billion in capital expenditures for this next year, about 2.1 is going to the Strawberry Wolf Camp. So that is the play. That's the elephant that they're really trying to hit. And as shareholders, the growth is fantastic at this company. They're looking at about 20% growth for the next 3 to 4 years. And if the Strawberry Wolf Camp really turns out to be as good as it is, that's going to be the best play in the United States. And you're going to see this company really soar.
So do you think it's a buy opportunity if it got 3% hit, or are you still a little wait and see?
If the potential's there, which right now with some of the drilling, this next year is really going to prove once they put all that capital expenditures throughout the Strawberry Wolf Camp. But if they start hitting the numbers that they're expecting, this company with that type of growth will be phenomenal. I think it would be a great buying opportunity. But if they go and start drilling and don't hit it, you could be worrisome. So you want to wait until maybe the first quarter, second quarter to see some of these wells that are coming online, and then kind of judge what you think is the rest of the play might hold.
Yeah, we're going to see it right in the first quarter because they're going to move from 5 rigs on the ground at the end of 2013 to 16 by the end of the quarter. So a lot of drilling activity going on in this first quarter. So maybe even try and sift through some local newspapers and see if they have some initial well results, and you can maybe get in before they release the numbers to the masses.
All right, we'll have to check in on them again later. Then our preview is going to be for Gold Corp, ticker GG. They're expected to announce on the 13th.
That's right.
Taylor, what are you going to be watching for?
Well, they already kind of released some of their initial projections for 2014 and the next few years after that, but that was before gold started to take a little run here in the beginning of 2014. So I'm interested to listen to the Q&A from analysts to see if they maybe pepper them to see if some projections have changed over the last month. Not for the next 3 years, obviously, but maybe just for 2014. This is a company with the strongest balance sheet in the business, and that's what you really have to look for in the mining sector right now, because there's so much worry and volatility with these stocks that you really need to be able to weather a downturn, which I don't think there is going to be much more of one in the gold industry, maybe flatlining for a little bit, but the fact that they only have a 12% debt to equity ratio versus the industry standard of 35% really speaks volumes for what they've been able to do while increasing production in the face of a lot of headwinds.
Yeah, I definitely agree. And what I'm going to be really looking at is this last quarter, or the third quarter, they had their all-in sustaining cost down to $992, which is one of the industry best. But if you look at the quarter before that, it was up to over $1,200, closer to $1,300, which is where the price of gold is right now. So if they continue or even keep their costs down like they did there, I think this company is in pretty good shape. But you want to make sure that it stays low. You don't want it to climb back up to that $1,200 range.
Yeah, they have a couple mines that are right there at the price of gold to produce out of, and they kind of trim back a little bit. So maybe if you see the price of gold, they can return to those assets again. But right now, they've wisely kind of cut back.
Well, that's going to do it for today. If you're looking for more energy sector coverage, head to Fool.com or follow us on Twitter @TMF Energy. For Taylor and Joel, I'm Allison Southwick. Thanks for watching.